Well, good afternoon, John. Good to see you. We are recording this video on Wednesday afternoon. John, it's been another hectic week with President Trump firing off executive orders, tariffs driving markets up and down, lots of activity, lots to speak about. We started the week with the market clearly reacting negatively to the imposition of tariffs of 25% on Mexico and Canada and 10% on China. And then President Trump seemed to agree to defer those for 30 days. Another consequence has been a very strong US dollar and also money going into gold. How do you see these tariff issues unfolding? And let's try and focus particularly on the possible consequences for the Australian economy.
I think you go a little bit mad if you start getting into daily commentary about Donald Trump's machinations, because it is, as one commentator, which I respect, said recently, it's like watching a TV show and every day is different. So it's entertaining, but we can't get too caught up into it in terms of what it means for markets. And I think markets going up and down is what they normally do, and Trump's just adding a little bit more volatility to it to give traders something to trade around. But I'm not really that interested in that, so to speak. In terms of the tariffs, I think we're seeing the play. It's a threat. It's a bargaining chip. We talked about this recently. He's trying to go to bargaining chips because he's a negotiator. He makes a claim, makes a threat, and then sees what he can negotiate and then withdraws the threat. Obviously, the issue is when he gets some sort of concession, and it's a concession which is over 30 days, it's going to be interesting to see whether the other party, like Mexico or Canada, can follow through in that time frame. That's going to be the interesting thing, and whether they want an extension. And I suspect there'll be an extension being granted all over the place, which will make this, again, a long-winded TV show. So I really don't want to get, in terms of Australia, I just maintain the biggest issue for us is, as you said in your opening remark, the US dollar continues to strengthen, which means other currencies weaken, Australian currency weakens, and it's a real dilemma for Australia in terms of the inflationary effects of that. And I noted driving on Monday back from the north into Sydney, the petrol price sitting above $2 a litre. Now that's the consequence mainly, I guess, of the Aussie dollar being so weak because the oil price hasn't moved. And this is the ramification of weak currency, Paul. We're going to be inheriting inflation, and this puts the quandary in the Reserve Bank, as we've said. Do they cut and put more pressure on the Aussie dollar, or do they hold it and hope that the Aussie dollar can revalue a bit before they do cut in the next quarter?
Yeah. The main mechanism seems to be that if global trade suffers, then Australia's exports to China might be impacted. So that seems to be the mechanism. But the reality is, if the Australian dollar falls, then those exporters will probably find other markets anyway for their goods. So it's hard to fathom how Australia, which has a trade surplus with the United States, should be that negatively impacted.
Look, there's two aspects to this, and I think we've got to be very clear. It's not a tariff, and we've seen this in Canada in particular. It's not a tariff which is on all imported goods out of a region. It's selective. Clearly, it was stated there would be no tariffs on oil coming across the, unrefined oil coming across the border, or gas. And that's a big slab of the imports coming out of Canada into America. So it's selective tariffs. Okay, so the impacts are very much overstated by looking at the total trade, is the point there. He's also, as your other point was, it's a big world. It's a big trade world. And America is important, but arguably they overconsume. When you look at trade and consumption, the American consumer overconsumes. And the sustainability of that overconsumption is probably under threat. and the threat comes from the excessive debt in the American economy, mainly through government. So that surge in consumption of America, trading against China and importing Chinese goods, I would have thought the only thing that could drive it from now, all things being equal, would be population growth, which is immigration, which is what he's going to stall anyway on the southern border. The bigger risk, if that is the word to use, is that this sort of tariff war pushes China towards Europe in terms of a trade. You know, as I say, America's not the only game in town. We saw this in Australia when we were barred during COVID on exports. We found other markets. And I think it's very naive to think that China won't find other markets. And it's also naive to think that China won't respond. We've already seen the threats of tariffs on exports from China to America, or imports from America to China. But we've also seen a cut, probably deliberate, in the Chinese currency. So it's devalued. Won't offset the amount of the tariffs, but that's what they'll do. They'll let their currency weaken. That makes China more competitive in markets away from America, sustains their economy. And as China grows, and there's enough evidence about it, they're 1.25 billion people. As they grow their per capita GDP, they have more local consumption, and they can support their own industry through internal trade. So yes, there are issues, but I think there's counterbalancing forces which are in play, which sustains Australia.
John, I'd like to just tease out your thoughts on something that you referred to, which is that the Reserve Bank's hands might be a bit tied if the Australian dollar collapses further. And I know both of us were watching this late last week and thinking that, well, if the Australian dollar falls in dramatic fashion, it might mean that the Reserve Bank would probably not want to cut because it makes imported inflation more of an issue, makes the yield differential between us and other economies greater. But the futures markets are now pretty confident that they will cut on, I think it's the 18th of February. Is that your view at the moment?
Well, I'm a typical economist, Paul. You know, I can see both sides of the decision. You know, I've said there's no reason to cut, and there's every reason not to cut because of the currency. But we're in a mess, you know, and I've said it for years that the Central Bank of Australia has mismanaged the interest rates of Australia, mismanaged credit creation and access to credit, and created one of the greatest housing bubbles and household debt situations. We are still the highest per capita household debt in the world. We're a wealthy country in terms of household assets, but we're a very indebted country in terms of household debt. And that's because the central bank and the regulators, including APRA, did not regulate the financial system appropriately. Now, they will say, oh, you can't blame us. I'd say you can blame them. They've caused an almighty mess, and it's because they didn't use all the prongs of monetary policy to control the financial system and the asset price bubble we've had in housing. Now, having said that, we've got a very weak currency. The reason we have a very weak currency, I keep on saying this, is because we are putting way too much money in long-term savings through super, and 70 cents on the dollar is now flying offshore and selling the Aussie dollar going into America, which is adding to the demand for US dollars. And the indexing of investing in US assets is pushing up all asset prices, particularly we know the American index. Now, Australia is oversized in terms of our investment as a country per capita in America. And the Americans are very happy to take our money. So, back to your question, I can see both sides. I can see that there's a panic now, a highly indebted economy, highly indebted household sector, real income's falling. One way to stimulate real income is to cut interest rates and let more money flow to households after servicing mortgages. Clearly, it could be what they're thinking to take the pressure off the household sector. But there's a lot of problems with doing that in terms of the Aussie dollar inflation. If I was Reserve Bank, I would do nothing, but I'm not the Reserve Bank.
John, we're going to have to talk about politics a little. There has to be a federal election, I think, before the 18th of May this year. the government would dearly love the Reserve Bank to cut interest rates, but economic growth in Australia has been sluggish at best. Retail sales came in perhaps marginally better than expected. But I'm sure many of our viewers are very interested in what Jim Chalmers' plans are for superannuation. Now, you appear in a news article published in the Australian today, together with Jeff Wilson. Jim Chalmers has got a proposal that would tax unrealized capital gains above $3 million in self-managed super funds. Tell us what this is all about, John. It seems like a crazy proposition to me.
Well, there's two aspects. One aspect is not being talked about, which would be a proper policy response, which is saying what would be a reasonable amount of money to have in super. That used to be called the reasonable asset test. That's not what we're debating. That's a different issue. And I think a lot of the commentary by pro-government forces are saying, oh, we're just taxing people who've got too much money in super. That's a red herring. That's a different argument. I'm very happy to have that discussion about what is a fair amount in super. This is about creating an unrealised capital gains tax. Unprecedented in Australia. Yes, there are taxes on market movements, but not an unrealised capital gains tax on savings. Absolutely outrageous. People have got to remember that the superannuation system has three planks. The long-term retirement policy of Australia has three planks: superannuation, account-based, individual; Commonwealth Commonwealth pension for those who don't have enough in super; and the desire as a community for people to own their own houses, if at all possible, in retirement, so they're not laboured with rent. They're the three planks of a long-term retirement policy. If you start having unrealised taxes on one plank, which is super, then it's not a long bow to start saying, well, if that gets through and there's not an uproar about it, let's start putting unrealised taxes on property. And it causes chaos. When you start taxing illiquid assets, then you can cause depressions in prices as people are forced to sell, not for logical reasons that it's a good investment, but for a logical reason they've got to meet a tax liability. There are much better ways to reform the superannuation system of Australia. I'm all for reforming it. I've said it over and over again. Can we actually work out what we're trying to achieve? Once we work out what we're trying to achieve, let's make appropriate changes which are bipartisan, are not debated on a political basis to score votes, to chase votes in one part of society, which is probably Labor sees this as an easy vote picking for kids living at home who now get a vote. They didn't get a vote 3 years ago. They're living at home and have no idea of unrealised taxes or what it means to save for 40 years and have a law change just as you're entering retirement regarding how all the basis you save money on, no, we're changing that now. Sorry about the last 40 years, we conned you. It is outrageous. The government ought to have the integrity to have a commission, a national inquiry, with intelligent people recommending to government and the parliament about what should happen and not come up with brain snaps like this from Treasury. The other aspect, I don't want to labour it, is there is a huge liability in unfunded defined benefit scheme pensions in Australia. Commonwealth public servants, politicians, High Court judges and defence personnel, in particular senior defence personnel who probably spent decades behind desks but managed to retire in their mid-50s. There is huge liabilities. And no one wants to talk about it, but the taxpayer is paying it. The guy who goes to work every week and pays his tax is paying into consolidated revenue, and out comes unfunded pension payments. No one has any idea how these unfunded pension payments, which are indexed for life and can then be converted to a pension for a surviving spouse, no one has any idea how they're going to be taxed or what effect it has on them, if any. So this whole debate which is going on in Canberra as we speak, with senators who are trying to barter for personal things they want, is a disgrace. And the Australian people needs to sort of say, look, we've had enough of this nonsense. If we're going to have a super debate, can we actually have some recommendations where both sides of Parliament agree on a national savings policy? Not these superficial changes which upsets everyone and upsets long-term savings planning.
One of the coalition's proposals is to introduce a $20,000 write-off for entertainment and so on during the course of business. I think you and I are both old enough to remember the introduction of the fringe benefits tax and how it decimated the restaurant industry. Is that something that you think is a sensible idea, or is it something that you think is not going to fly?
Oh, look, I'd want to, again, I'd like some of these policies to go through a thought process with the pros and cons. There are some aspects I like. Australia is a service economy. A lot of people start up businesses, a lot of people start up businesses in food and restaurants and cafes, and a lot of people fail. Now, would this sort of policy stop failures? Probably not, but it might help some businesses go from being marginal to being fairly profitable. And what we want to do is get a lot more small businesses growing and employing people and offering opportunities to new people coming to Australia to work. There's some good aspects to this, so long as it's not rorted, $20,000, limiting the type of company which can utilise it, not subsidising alcohol, for instance. There are some aspects which I like. There's some aspects which I like to think about and understand. I wouldn't wholesale say yes, and I wouldn't wholesale say no. But what we have in Australia, again, is an idea. Is it a thought bubble? I don't know, but immediately the other side says no. You know, and it's painful. We would be much better serviced by having proper ideas coming to Parliament from think tanks which have gone through a proper thought process, not coming out of ideas out of a black hole on the opposition side or coming out of volcanoes or chasms coming out of Treasury and public servants. I mean, honestly, there's absolutely no idea whether this is a great idea or bad idea because no one puts the facts on the table.
John, I know that you keep a close eye on the Future Fund because it is really liable for a lot of those pension payments that you were referring to earlier. They've actually had a very good year during calendar 2024. I think they returned 12.2%. But part of the reason was because they ramped up their exposure to overseas shares. And the amount in super that is going offshore is one of those factors, I suppose, pushing down the Australian dollar. It's a bit of a conundrum, isn't it?
Yeah, look, I've got to do a little bit more. I like watching the Future Fund, how it reports, and they said they increased their exposure to international equities in December. I think they probably increased it because the Aussie dollar fell and the US market went up. So whether it was a decision they made or whether it was just asset values going up based on, I won't say luck, but based on the US dollar and the Australian dollar and the American stock market, I think that's more to say. Look, the return was good, but it's a high growth fund. It's not a balanced fund. It's a high growth, high risk fund. Now, heavily exposed to US and heavily exposed to a weakening Aussie dollar. So if you backed out the Aussie dollar effect, I'd say the return was probably closer to 10%. Their long-term return they claim is good. You know, I think they're claiming around high 8% over 10 years. And they said the average is, they're running an average about 1.5% above their target of low 6% returns. But that's the effect of compounding. And people need to understand the mathematics of compounding. And I'll leave you with this conundrum, or our viewers with this conundrum. If you invest at 6.25%, compound it for 10 years, don't take the money out, what will be the backward average return looking back after 10 years per annum? The answer is 7.8%. So 6.25% compound turns into a backward-looking 7.8%. That's the effect of compounding. And one of the great issues for Australia is, you know, industry funds and the future fund who are managing a lot of accumulation funds, not meeting the requirements of pension. It's great, you get compounding working. But as soon as you start paying out pensions and you lose the compounding rate of return, those returns will drop. And I think there's got to be a lot more honesty in reporting returns, particularly by a fund like the Future Fund, which has no tax, no pension payouts. Is that return as good as they say? I think it's a little bit overstated, is my point there, but well done. I'd love to see them pay some pensions. That would be good.
We probably have run out of time, so I think we'll have to end it there unless there's anything that you want to add as a final point, John.
No, I just reiterate, the Trump issue, and we've just got to be watching what happens in terms of particularly the tax, which may be coming, the tariffs on Europe, and what effect that would have on Europe. And I am watching if and he must be being advised on the consequences. This is a massive chess game, and I think he's moving all his pawns out, and he's happy to sacrifice a few. But I don't think he's a great chess player. I don't think he's someone who's going to sit at the chess table for 3 or 4 hours and work out a strategy. I think he's very much full frontal, and then he'll withdraw. Now, there is a risk that a wholesale movement of tariffs around the world could push certain parts of the world closer together. I think, if he pushes Europe closer to China in terms of trade, it might backfire on him. I suspect at some point he's going to sit down with China and he's going to start bartering. And I suspect he's going to start bartering with India as well. And one of the things he's going to ask them both to do is to refrain from buying oil of either Iran or Russia. That's got to be his political game, to start starving those countries with foreign income coming out of oil. Now, Europe is weaning itself off Russian gas. But by God, they had a war to make them come to that conclusion. I think Trump's going to force through some of these economic desires through tariffs or the threat of tariffs. But it'll be interesting to watch, because if he does too much, he could force a result he doesn't want. If he does, but he's got to move quickly and get negotiations going.
Yeah. Well, we will have to leave it there. We're certainly living in interesting times. Thank you very much, John, and we'll see you next week.
See you next week.